Well, let's make sense of the markets. What does it mean for all of your money? Joined by Gary Dugan, Chief Executive Officer of the Global Chief Investment Office. Morning, Gary.
Good morning.
You could say it better than me. The Global CIO Office. Gary's here. Gary, we're looking at the elections happening around the world at the moment and what it means selfishly for our portfolios, because that's what you do at the CIO Office. And you've done some analysis, so we're going to go around the world, starting east and moving west and figuring out what we have to do. Let's start, first of all, in India. Election results last week. Narendra Modi gets a third term as Prime Minister, but his majority is severely restricted. Indian stocks sold off sharply on the back of that news this time last week, but have since recovered and closed yesterday close to record highs. How do we play this one?
Yes, I think the foreign investor was the seller and the domestic investor is the buyer. And I'm going to run with the domestic investor. Yes, the headline news looked bad. You know, you've got someone who's been a huge personality, a person who's made substantial changes in India, all for the good in the main, and he doesn't get voted in so comprehensively. And I think it really is this third term fatigue that we often get around the world. I wouldn't just pin it on Modi and say that therefore he's a bad politician and there's bad news to come. There's good news to come. I think a more moderated policy that spreads across all branches of the economy, and particularly into the small and medium-sized companies, which have been left behind in the previous rally.
Well, there have been concerns raised about valuations in India. Leaving aside the politics, the Sensex close to 77,000 points at the moment. Small and mid-cap indexes also high. Various brokers, fund managers talking about elevated valuations, maybe even bubble valuations. If you look at a basic metric like price to earnings, India is one of the most expensive stock markets in the world.
And quite frankly, it should be. I think, you know, if you're looking at valuations, you've always got to think about, well, where's that valuation coming from? And it's the perception of the future. This is one of the few countries out there likely to, you know, with a lot of confidence, I believe, grow at above 5% GDP growth per annum, a huge population that, quite frankly, again, has not really been put to work in the most effective way by previous Modi administrations. And I expect unemployment to fall. I expect more money going to the common man, me. And we are going to see, I think, a consistency of earnings growth and profits growth to support the market.
So how do we play the Indian market? If we think we like the India story, even at these valuations, do we just go and buy a Sensex or a Nifty 50 tracker fund? Do we pay a bit more and have an actively managed fund by a Schroders or a ICICI Bank or whoever it may be?
Yeah, in recent years, it's been largely those ETFs to just buy the index. But when you've got this change of policy, which is going to be focused on the middle of the economy as opposed to the big companies, that's when you want to be involved in small and medium-sized companies. Therefore, if you're going to buy access to India, don't do it through an ETF. Do it through an actively managed fund. Many of these fund managers put bets on small and medium-sized companies, and that will add value over the index.
But, okay, and I'm in the market for that. As regular Business Breakfast listeners will know, I'm an overseas citizen of India. My wife's Indian. So, you know, we do have exposure in India. And I'm thinking the same. I've had ETFs before and I've done well out of them, but now is the time to go for an active manager. I've absolutely no idea how to pick the right active manager. This is a common problem in investment.
It is, but the good news, India is quite exceptional because if you look at the active managers, the majority, not the vast majority, but the majority of managers beat the index over extended periods of time. Now, they've all been struggling over the last couple of years, and you might look at the recent history and say, I don't want to invest with this active manager. But I think market conditions are now set for active management to outperform.
You're not going to name names. You're not Morningstar and going to give me a 5-star rating on a particular fund. But are you inclined to go with a locally based fund manager, whether it's a ICICI, one of the big banks, or one of the Mumbai-based fund managers, or would you go with, for example, an actively managed Goldman Sachs India fund or an HSBC type India fund?
I prefer the local managers, but to be fair to the brand names you've mentioned, they've often got people on the ground. And it is important to have people who are traveling around the country very consistently, listening to the mood, because that's where the action is going to be. It's going to be in those small and medium-sized companies where the information flow is not so good.
Right, let's talk about Europe now. European elections over the weekend. I don't normally pay a huge amount of attention to European parliamentary elections because they're not the big deal. The big deal is the election that we've got, for example, coming up in the UK is the prime ministerial election. But the FT's gone big on it this morning. What's their headline? Markets rattled by Macron election bet on stemming the far-right advance. And the CAC 40 in Paris down 1.5% yesterday. How seriously should we take this?
I just don't understand why Macron took that decision. He's only highlighted the bad news that came out of the election, which was this swing to the right. But if you just look at it with a cool head, you would have said the centre of politics is still centrist. It is still remarkably not extreme. And we should have just let things calm down for a few weeks. Instead, he just jumped straight in and unfortunately has rattled the cage and is causing damage at the moment to the political scene and to the markets in Europe.
So do we buy, sell or hold? French banks in particular hit yesterday. I think Société Générale was down 7%. Do we buy the dips or run away?
I would buy the dips. I think, Europe on an underlying basis is making a comeback. We've had a cut in interest rates. If people are a bit gloomy here, it's going to suppress some of the inflation pressure we've got. And therefore, I can see the equity market rallying in weeks to come. But we may have to wait beyond the French elections.
And what do we buy in Europe? Again, do we go, what's that acronym? The granolas, wasn't it? The likes of Novo Nordisk, which makes the weight loss drugs. Do we buy the granolas? Do we buy an index?
I think you want to buy the index, but, a lot of focus on domestic stocks because that, I think, is where the story is. And we've also seen a bit of a comeback in the luxury goods companies on the hope that China will bring some stimulus to their economy, which will bring in the luxury goods demand in the fourth quarter of this year.
I've spent a lot of money on LVMH, but sadly not the stocks, the overpriced merch. We said we'd go east to west, and we're going to finish in the United States. We've done India, we've done Europe, the United States. Election season there, of course. Early November is when we get the election. Record high last night for the S&P 500. Buy, sell or hold?
Hold, and I've got a bias to sell. Valuation is high here. And I think people are just hoping that something gets sorted by the end of the year. But it's in a presidential election. It's going to be scoping things for the next 4 to 5 years. And I think people have just put a blindfold on, put the headset on, and don't want to hear the news. And the news is difficult. This country's got too much debt. It's got poor leadership. It's got growth that's starting to wane, and it's got interest rates coming down extremely slowly. Not a good setback drop to an equity market.
In terms of interest rates, we've got a Fed meeting, starts in a few hours' time. Interest rate decision yesterday. European Central Bank cut rates last week, so did Canada. The Fed has remained stubbornly high. Where does that go?
It's all about the dots. So it's not about the decision. We think they're going to leave interest rates unchanged, but it's their predictions for how many cuts in interest rates we see to the end of the year.
Oh, and we get a new dot plot tomorrow night, don't we?
We get a lovely dot plot. They've been out with their pens and they will have changed their forecast. So there was an anticipation of 3 rate cuts.
5 seconds left, final thought.
It'll be 1 cut before the end of the year.
Gary Dugan, Chief Executive of the Global CIO Office in Dubai. Always good talking to you.
Dubai Eye 103.8.
Join the conversation.